found it very intriguing in that scenario, and I interviewed him for about an hour, so that was just a short 4-minute video. If you want to watch the full thing, you can go to mistrade.net. The whole thing is there. But what was interesting about John's stamina, I think, and Greg even brought it up in the interview, was that he really did go out there and try to find every side of the trade that he was taking.
Exactly.
He didn't just go out there and blindly say, hey, I think this is going lower.
He looked at it from every single angle, and you have to do that.
And then the other thing I thought that was intriguing was not only was he convicted, but he kept challenging himself, going to the street, and he was trying to raise money. This is, you know, this is interesting. He was out there trying to sell people on what he thought was a very good idea to make a lot of money. And he had a big fund. He was probably $1 billion or $2 billion when he started. But he was trying to get up to that 4 or 5 to really parlay it. But he was not that successful in gaining the dollars because so many people were making money in the areas where he was betting against.
Exactly.
So I find that interesting that even the people that had made a lot of money didn't want to hedge themselves and maybe take a chance. And because really the way he set it up too was there was not a lot of risk. He was buying, you know, pretty much puts, if you will, on the mortgage market. So pretty interesting. Well, and also you know, at the back end in the last year or two, he's switched and gone long. You know, he went long gold. He went long a lot of things that you know, early on also that have, you know, a lot of people didn't see coming.
Well, it goes back to what we've talked about time and time again, and we're going to show a graphic of a model portfolio that I run, and for the benefit of our our viewers, you know, concentrated positions sometimes can make a whole lot of sense. I mean, we're looking at 1, 2, 3, 6 positions at this point in time, of which 45% is in cash. So while this may not seem like the traditional diversified portfolio, it is pretty well diversified. It cuts across all asset classes, but I didn't do it intentionally. I didn't do it like, well, I got to have bonds in here. I've got to have utilities. I came across these ideas because they made sense to me. And I think what people at home need to do when they're looking at their investments is take that same approach. Take this model portfolio, maybe implement it. You know, contact me at my office. This is what I'm starting to do for clients, is branch away from the currencies, do a little bit more on the investment management side, and offer some guidance. So, you know, as we do start 2010, you know, forget about having 12 different asset classes in your portfolio unless they all make sense, which would be very rare.
Again, when the volatility, you know, last fall there was definitely volatility, and you could spread your risk amongst a number of different positions. But I think when we get into these less, you know, volatile times, which we're back in again, hard to believe that we were at 100 on the VIX and we're back to teenage, you know, 19. But you're back to a slow time, so don't over-diversify yourself into a portfolio that's going to really be mismanaged. I think over-diversification.
And you'll probably have a ton of overlap. Especially if you're using mutual funds. You know, you might own the Fidelity Growth and Income Fund or whatever.
I think that's always a good thing for people to do. You know, do you own 10 mutual funds? And if so, go see what is actually owned and held by those 10 funds.
And you'll be shocked.
You'll be shocked how many are crossing, and you'll end up saying, well, if that one's got 4 of these 6 names, I don't need to be in both of them.
And you know, this is probably a topic for our next show, and we should talk about it, but mutual funds are probably just one of the most disastrous ways to invest.
It's a dead breed. I mean, for sure, you know, with ETFs and the simplicity and the cheapness of doing your own investments now, I think you can perform better than most mutual fund managers.
I think we should go into depth maybe next show or an upcoming show on mutual funds. Matt, what's your pick this?
I
was shocked when you showed me the chart. I couldn't believe it.
I'm gonna take a counter bet to Priceline, the old William Shatner commercialized product. But if we had the left side of this chart, I was also saying to you, Dave, that this stock actually reverse split, which means it was trading at about 20 cents, and they sold one for 20. So they diluted it and made it into a $5 stock again, back somewhere in the 02 range. And I think the stock got up to $1,200 or $5,000. It was so outrageous.
So basically what you're saying is despite this massive move, we're still
probably 20% of the all-time highs of the stock. That being said, we've had a huge move, fivefold, almost sixfold, $40 to $240 in Priceline. Now, this is pretty much a chart trade to me. I wouldn't necessarily suggest everybody get short this name directly unless you have some risks and risk parameters in play. But I would buy some puts, maybe some 250 strikes, March, April timeframe, and take a stab on that side.
Do you view it a little bit as a kind of like a lottery ticket type trade? It's one of those things that you put some puts on.
Yeah.
One day you wake up.
I think if it goes over 250, you got to respect it, and that's
and
your
then,
risk. So you're risking 10% on the trade is your loss, parameters on that.
I totally agree with you there.
That's what I would do on that. So, how about you, Dave? You've got again a currency play with the Aussie dollar and the Japanese yen here.
Yeah, pretty straightforward here. I'm of the belief that until the market, meaning the S&Ps, decide they want to go down, I'm going to believe they're going to go higher.
Right.
That would favor the Australian dollar. And then a real simplistic, if you put your money in Australia, the overnight rates are 3 3/4. In Japan, 0.1%.
Right. So you're getting paid again.
You're getting
to
paid
hold the position.
You're getting paid interest of 3.65%,
right,
plus maybe some capital appreciation. Now, unfortunately, there's not an ETF for the Australian dollar, Japanese yen, but if you are inclined to open a currency account, you can buy that position, and that's what I'm betting on. I bet this is a
again,
year-long.
It's an inflationary bet, and it's one, I think, like you said, it's two-sided. You get the interest rate coming to you and potential upside.
And I see it as a longer-term trade. This is one of my themes. I think the yen is going to be a real weak performer.
Where's your risk on it? Where do you get out?
Probably get out down under this low. So it's a decent-sized risk on a percentage basis, but the upside's pretty good too.
Okay.
So, listen, that's all we have for you today. Again, Happy New Year. We're going to have a prosperous New Year on the show. We've got a lot of exciting ideas for the shows ahead. For Matt Davio, I'm Dave Floyd. You've been watching The Trading Desk on COTV, Channel 11.